Fedmaster says rates will need to go over 5% to fight inflation. This inevitably will lead the United States economy, as well as most likely Europe and the rest of the world, into a recession, as that is typically how things like to operate. Well, from now until then, we got some catalysts coming up that will furthermore push us into that inevitable recession. And we're going to be going over those catalysts in the near term here in this video. So we're not going to waste your time. Hit that like button, subscribe to the channel. You know the deal. If you like the content, if you learn something that is provided to you in this video, it is free 99 after all. So this just came out. Fedmaster says rate target will need to go over 5%. Quote, precisely how much higher the federal funds rate will need to go from here and for how long policy will need to remain restrictive will depend on how much inflation and inflation expectations are moving down. And that will depend on how much demand is slowing, supply challenges are being resolved, and price pressures are easing, Master said in a speech before a group of economists in New York. And I think this is very important because in regards to events that have happened recently, we just had OPEC cut the supply of oil, and I think that is big here because when the price of oil goes higher, that makes inflation much stickier, but it also affects inflation expectations quite a bit. And you can see after OPEC cut their production of oil, inflation expectations actually went higher. This is making the Fed's job that much more difficult, and that is going to make these catalysts much more important, which inevitably will lead us into that recession, which this is going to be the most televised recession of all history, which is the most ironic part about it. Maybe we're all expecting a recession and then it doesn't end up coming. That would be the contrary opinion in this current market. Now, she also says, quote, I was very comfortable with moving ahead with the rate rise, given that authorities had taken steps to manage risk coming from the banking sector troubles, Master said in remarks following her speech. And this is pretty interesting as well, because just what you've seen yesterday, Tuesday, April 4th, Jamie Dimon came out with his annual shareholder letter and said the banking crisis is not over with, and it will have rippling effects on the economy for years to come. And that is part and part why the markets actually sold off yesterday, Tuesday, April 4th. And that was not something, obviously, that the markets like to hear. Now, let's get into these big catalysts. And number one, it's going to be the unemployment rate and the payroll report. That is going to come out on Friday. And the interesting part about this is the markets are actually closed on Friday. So at 8:30 in the morning, you're still going to get the unemployment rate and the non-farm payrolls. I can't recall the last time you had data come out on a Friday when the markets were closed. It definitely hasn't happened in recent history when data has been so important, when data points have given you 2-3% rallies or drops on any given day, which has been really in the last year. You haven't got any data that was this significant coming out on a Friday, a day the markets are closed. So you're going to see the reaction from this actually happen on Monday, and you might actually see the reaction, the pre-anticipatory reaction on Thursday as well. So that is something that I would definitely pay attention to. Now, the unemployment rate is expected to come in at 3.6%. Now, the unemployment rate needs to go higher per the Federal Reserve. If the unemployment rate or the non-farm payrolls are any kind of measure of economic activity, or I should say the JOLTS job openings report that we got Tuesday is any indication of where these numbers are going to come in as, boy, we are in trouble. The job openings Tuesday for the month of March came in at 9.93 million. Wall Street was expecting 10.4 million. That was a 600,000 miss to the JOLTS job openings. Now, that is a big deal because that essentially means, call it, if you have a Dollar General that is looking to hire one person, well, that is one job opening. Well, now 600,000 of those job openings are now gone. So that constricts the labor market. That is showing you the economy is slowing down at a much faster rate than Wall Street had expected, and that did contribute to the drop that you did see on Tuesday. Well, for the non-farm payrolls, this is the net job add or loss for any given month. For the month of March, you were expecting a net job add of 240,000. February's number was 311,000 jobs. So you are expecting a very strong jobs report, and I think these numbers are a little bit high compared to, again, the JOLTS job openings that were massively wrong. I mean, no economist got this right. Everyone dropped the ball on that. So I think these expectations are a little too high, might come in lower, and the markets, they're not going to like the economy deteriorating when inflation is almost 6% still, right, on a year-over-year basis. So potentially not going to be a good thing. Now, on top of that, you're going to have CPI on April 12th. And that is going to fall on Wednesday. That is actually next Wednesday. And the core inflation rate year over year, this is really the number that the Fed is going to care about. Core really excludes food and energy, very volatile sectors of the CPI report. You're expecting a forecast of 5% year over year. Now, the inflation rate year over year, you're expecting 5.8%. The inflation rate month over month, you're expecting a negative 0.1%. So you're expecting deflation on the headline CPI reading month over month, which is insane to actually think about. And the core inflation rate month over month, you are expecting that to come in at a positive 0.4%, down from February's reading of positive 0.5%. Now, 0.4% month over month inflation on an annualized basis is 4.8%. So that's still way above the Fed's 2% target. So if inflation does come down a lot, maybe if this number came in at 0.2%, right? What's that? That's 2.4%. That's a lot better than 4.8%. So if you do get that weaker inflation report, that's going to be very positive because the markets right now, you're expecting massive rate cuts by the end of 2023. The only way you get there is if inflation completely falls off a cliff, meaning these inflation reports, the inflation report comes in a lot less than what people expect. Rate cuts would seem more logical. If it does not, if inflation remains stickier than what people expect, well, the markets are in for a pretty massive sell-off at that point. There's been a lot of expectations of rate cuts baked into this valuation, right? Specifically the tech sector that has carried the way in 2023 so far, causing the NASDAQ to rally 24% from the low in early January to where you ended the first quarter of 2023. A lot of it has to do with Fed easing or expectations of Fed easing. If inflation does not come down, Fed easing will not happen. And that's why these catalysts will be so very important. Now, as well as that, next week, the same week where you get CPI, you're going to get bank earnings that will start mainly on Tuesday and on Thursday. You're going to get the big dogs that start to report earnings. Now, bank earnings will be important because they will give you a lot of commentary on the state of the consumer, where deposits are going, where capital is going. We kind of heard new information that even big banks are seeing a lot of outflows into money market funds, right? Kind of like the bond market over the last couple of weeks as well. Something a lot of people didn't really see coming. And that came with Jamie Dimon's letter, shareholder letter that came out yesterday as well as some other data points. And bank earnings, I mean, do I even have to elaborate on why they're going to be important? I don't think I do, but That's the quick summary, right? You want to know how the consumer is doing. You want to see if banks are holding up. If banks can't hold up their numbers, well, it's going to be very hard for other companies to also hold up their numbers. As well as that, you want to watch the bond market. Now, this is not really a specific catalyst, I would say. It's not like a data point that comes out, but you want to watch the bond market because when bonds go higher, stocks go lower. Now, this is really because in this market environment, when your safety trades are being bought up by investors, where in Q1, your top 5 to top 10 large, stable tech companies, your recessionary proof tech companies did very well. That was a safety trade. Bonds did very well. Gold did very well. Bonds did very well. Everything basically did well in the safety trade. Well, if bonds continue to go higher, that means yields are going lower. Why are yields going lower? Why are people rushing into bonds? Well, because they're afraid. What are they afraid of? Economic growth slowing down, leading us into a recession. So believe it or not, if the bonds continue to go higher here and really break out from this triple top formation that we have, which is pretty clear on TLT around 109, if you start to break out from here and you see a real panic rush into bonds, well, that's gonna tell you something. Usually the bond market knows what is up, more or less, with the economy before the stock market does. So you want to watch the bonds for a leading indicator here. If they continue to go higher, it's going to mean some pain for the real economy. Although it is going to push rates down, and that's what you've seen on Tuesday. TLT was up 0.5% and up 0.3% after hours, and the markets were down about 1% across the board. You could see there's going to be an inverse relationship even though yields will be falling. Now, on May 3rd, you're going to get the next Fed meeting. Now, the next Fed meeting, investors are expecting the Fed to pause. It's really going back and forth, and the way you can look at this is the Fed Funds Rate Monitor tool. And this is just looking at the probabilities based off the bond market. And right now, 45.2% of investors expect the Fed to raise rates 25 basis points. 54.8% of investors expect the Fed to pause. So you are pricing in a pause right now, but it's really going back and forth. Yesterday, or on Monday, really, 60% of investors were expecting the Fed to raise by 25 basis points. Now it's completely flipped, where almost 60% of investors are expecting a pause. So it's going to be very volatile here, but really by May 3rd, we're going to get more commentary from the Fed. I doubt this is going to be the last rate hike, and that could be a bad thing for equities because, again, a lot of this valuation in specifically tech is based off of the number one, the economy holding up, inflation going down, and the Fed reducing rates by the end of the year. None of those things look very likely right now. So that could spell some trouble here. The Goldilocks scenario would be inflation falls faster than expectations, earnings hold up, and the Fed would be able to cut rates, right? That's your soft landing scenario. That's the best possible outcome here. Does it look likely? No. Is it a possibility? Yes. Is it more likely that inflation remains higher for longer and stickier than what we expect? Yeah. Is it most likely that earnings underwhelm and are worse than expectations? Yeah. And is it most likely that the Fed stays higher for longer with the Fed funds rate and they don't cut rates in 2023, which they have said repeatedly that they are not going to do? Yes. So when you balance the risk reward here, these are the major catalysts you need to be watching for in your portfolios. These could be the catalysts that really send this market to new highs or new, 2023 highs, that's for sure. Or get the markets to feel a lot more pain, guys. So that is going to do it for this video. Hit that like button and subscribe to the channel if you have not already. Thank you for watching, and I will see you in the next one.